My name is Pesh Patel, editor at Trade Finance Global. Today we're at the IFC Global Trade Partners meeting in Barcelona. The Asian Development Bank revealed that the trade finance gap grew to $2.5 trillion from 2023. That's up from $1.7 trillion in 2022. This is despite the industry's best efforts to slow down the growth of the trade finance gap. The question now is, how do we actually decrease the trade finance gap? And there are lots of approaches. Today we're going to be discussing how multilateral development banks can help and the role that credit insurers play. I'm happy to welcome Azzizza Larsen, Lender Solutions Group Leader from North America, and Stephen Kay, Managing Director of Structured Credit and Political Risk at Marsh. Welcome to Trade Finance Talks TV.
Thank you.
Yeah, thank you very much for having us.
So Azzy, why is now the time for multilaterals to really gear up and increase their support for trade finance and supply chain finance programs?
Thank you, Deepesh. That's a great question. There's a lot to unpack there, actually. So businesses are facing an increasingly volatile world because they're experiencing seismic shifts in both the geopolitical and geoeconomic structures. As we know, there's the most elections happening this year in history. More than 40% of the population is going to the polls, and that will likely create a lot of political unrest and a lot of policy uncertainty. As we've seen since 2005, there has been double the amount of conflicts there's ever been, and they're extending for longer periods of time. We're also entering into a world where traditionally governments had, prioritized globalization and business-friendly policies, and that's kind of being sidelined now with regionalization, a lot of barriers to trade being put up. We're also seeing food insecurity as well as water scarcity being impacted by climate events, and that's also having an impact on, resulting in protectionist policies by governments. And on top of everything, we've got record inflation, as well as, continued high interest rates, and that's making the cost of borrowing and trade finance more expensive. So amongst all these headwinds, we're also facing a scenario where, as much as lenders want to support the real economy, they're looking at traditional methods of risk assessments, and that's disproportionately impacting MSMEs. Because if you're looking at collateral and balance sheets, financing, and not looking at performance measures, for example, then there is a limit to how much can be lent.
Thank you very much. And Stephen, I'd like you to perhaps unpack what we can do and what is happening, and perhaps you could talk about at a quite a high level how private partners, i.e. CPRI, help multilaterals actually mobilise finance to support their partner trade banks, particularly in the emerging and developing markets where you're seeing an exacerbation of these problems.
Absolutely. So maybe the starting point it will be my comment that the private credit insurance industry loves to partner with multilateral development banks. They will do things with multilaterals that they just will not do directly otherwise. The credit insurance market will follow, like for example, an IFC or other multilats into developing markets and support trade where otherwise they would not do so ever just because of the risks. And they do that because of the preferred creditor status that IFC can bring to the table, and which they will benefit from. Of course, the insurers are behind the scenes. They're not really sort of visible directly, but IFC is up front and center, and the insurance is behind the scenes supporting IFC on those transactions. So the insurers get the preferred creditor status benefit, but also they get the fact that the multilaterals generally in these trade support programs, such as the GTFP that IFC operates, undertake such a great degree of diligence and scrutiny that is way beyond anything that private bank clients can undertake, and that gives great comfort to the private credit insurers, and it shows through the fantastic track record that IFC has been able to show in their global trade finance program that has operated for 20 years today, and we're at that 20th year anniversary of it with zero credit losses and the insurers have taken note of that, and they certainly do benefit from that.
Thank you very much. And I imagine it also takes off some burden in terms of limit pressures, right? Can you talk about that and why that's so and how it helps the multilaterals?
Multilaterals in general, as the sort of the firefighters that are going into the country when everybody's trying to sort of get out of that building. And so the demands on an IFC or other multilaterals are quite great, not just on the trade side, but also medium and longer term lending and project lending and equity investment and, all kinds of different levels of engagement, very often, targeted at the same counterparty, the same credit counterparty. And so that accumulation of exposure with all these different bites of the apple, all these different products, results in concentrations of risk that even a multilateral, has to manage, and the ability to share those risks with private credit insurers is vital for an IFC, for example, to be able to accomplish their mission and to do more with the resources that they have.
Thank you. And Stephen, how can private market credit insurers continue to help emerging banks, perhaps without even the support of multilaterals?
Well, the way I see that is that supporting those same emerging market banks, those issuing banks, through a multilaterals trade support program like the GTFP is kind of like a stepping stone for those emerging market banks. Often, not that well known by credit insurers, to sort of become socialized and to become known to the credit insurers, to establish a track record, and at some point, that emerging market bank doesn't need the IFC program necessarily on every single transaction, and private credit insurers can step out in front and support the transaction directly with one of our commercial bank trade finance banks.
It is important to note that the private credit insurance market and brokers like Marsh have been supporting the mobilization of trade capital into emerging markets for decades now. So we've worked directly with commercial banks to support both on a single and portfolio basis on transactions to emerging market risk. Traditionally, it's been, over the last couple of decades, it has been traditional forms of trade finance like LCs and trade loans, but it has, evolved into a myriad of trade finance structures. And as a result, because of the proven track record, Stephen, that you were referencing of paying claims and the deep and long relationships that we've built with commercial banks and multilaterals like the IFC, there is deep pools of expert capacity and understanding of emerging market business in our market. And so I think over the years, we've been able to evolve and push and sort of enter more challenging jurisdictions. Mm-hmm. But at the end of the day, and the hope is that, again, there can be support both via multilaterals like the IFC and with banks directly. But again, with traditional emerging market risk in Latin America, Asia, Africa, that's been the bread and butter of the credit insurance market.
So emerging and developing markets is one segment. Women-owned businesses is another segment that suffers disproportionately from the trade finance gap. As was highlighted by yesterday's report, the IFC's Banking on Women Who Trade Across Borders report, I think it identifies why women-owned businesses are disproportionately affected by the lack of access to trade finance, stating that I think women-led firms only account for 15% of exporting businesses only. So, Azzy, given those discussions, given the white paper, can credit insurance policies also help bridge the gender gap?
Yeah, it's a great question, something we've been talking about a lot over the last couple of days. And I think, credit insurance as a tool can definitely help women-led businesses. There is a role for credit insurance to play in bridging that gap for that segment. When looking at credit insurance, right, fundamentally we're talking about non-payment insurance. Mm-hmm. And so that protection and risk mitigation aspect of it can help women-led businesses in terms of feeling more confident in exporting, knowing that they can resolve bad debt issues by getting insurance to cover any issues that occur with non-payment. And also another way credit insurance can be used is very much in helping to facilitate access to financing, and also kind of get better terms potentially by having that tool at the disposal of the business. They can go to the bank and say, listen, we've got credit insurance around our receivables. Can we get some financing attaching to some of the export-led activities that we're trying to do. I think one of the most important tools that credit insurance brings to the table is a lot of the insurance companies we work with have vast databases with fantastic information, and there is a real data issue, and there's obviously an issue around trying to digitalize things and trying to have more transparency around data. But these insurance companies are tracking payment terms with buyers in all parts of the world, doing country risk analysis, as do we. So all that kind of information and intelligence can help women-led businesses make more informed decisions in how they run their business and how they are able to do more export activity, so we can bump that percentage up from 15% and for them to be more meaningful players in the world economy. All that being said, it is really important to say that credit insurance is potentially part of the solution. I think one thing that's come about is there is so much focus on ESG and looking at supporting from insurance companies, supporting ESG friendly risks and getting behind that. But the focus has tended to be both on the bank side and the insurer side. It's been very much focused on E and the environment, but really trying to take some of that underwriting criteria and looking at, okay, well, how have we integrated looking at actually supporting ESG risks on the E side? Can we take that as a blueprint to potentially, take social factors and looking at, okay, women-led business, is this something, are there certain criteria that we can look at or contemplate that would, make it more likely that we would support these businesses, support the risks that they're undertaking? So kind of just trying to shift the narrative a bit away from E and the ESG and looking at more S. That's something that I think us as an industry, we could probably look to do better.
Thank you very much. So some brilliant examples of public and private partnerships, public being multilateral such as the IFC, private such as CPRI, support to multilaterals to really help mobilise trade finance in emerging and developing markets that really need it most. That was Azzizza Larsen and Stephen Kay at Marsh talking to Trade Finance Global at the IFC Global Trade Partners meeting in Barcelona.